And to tell us more about what's been making headlines in finance and economic news this week, we're joined by Suzanne Haddan, who is the Managing Director at BFG Financial Services. Suzanne, good morning to you. Always great to have you on.
Good morning.
Let's head to the Glasgow Climate Summit. We've seen a number of commitments from various countries, including that dozens of nations are pledging to phase out coal-fired power. Australia is not on that list, and I wanted to take the politics out of it and just talk about the implications for Australia of that result economically.
Well, we know that coal does power about a third of the world's energy needs, and Australia does produce more coal than we use. And what we're seeing is an acceptance that the production of coal is likely to reduce or will reduce over time for a couple of reasons. The first is demand is likely to decrease as you see more renewable energy, cheaper energy sources be developed both in Australia, look at what many of the state governments are doing, and also overseas. The other issue is it could become more expensive to produce coal because in nearly every research report I read about companies in the coal area, the top issue is climate and ESG. And not just because they might be out of favour from people wanting to support green energy, but there's also likely to be increased costs for borrowing, for financing, less interest in people investing and other services that actually could make the production of coal more expensive. So we're not expecting a rapid reduction in coal being supported, but we are expecting over time it will gradually reduce. Now, what's good about that is it gives time for our economy to embrace some of the other alternatives and make that transition, because the transition is inevitable. It's just how quickly it's going to occur that's up for grabs.
Suzanne, I want to head to the housing market because in New South Wales this week there's been talk of scrapping stamp duty. New South Wales Premier Dominic Perrottet standing by his intention to do that, although there's been some hesitancy within his team. He's maintaining that an annual payment is better than that big upfront amount. What are the pros and cons of both options?
Well, I can see why there might be some hesitancy because in the September quarter, New South Wales alone got $3.3 billion from this inefficient tax. Now, on the upside, we know that if we can make this significant transition to a lands tax, it would remove a major impediment for people to change addresses, for businesses as well. Because if it's 4 to 5% extra cost on your property purchase, people are hesitant. So think about the labour market. Sometimes there's opportunities that people don't take up because it's so expensive to move. They also might not move closer to a job because they're thinking, well, it's going to cost me $40,000, $50,000, $60,000 just to change over my property. So removing that impediment for that group would be helpful for the economy. Also think about people who might like to downsize their property. They're also very hesitant because of the huge impost. With first home buyers, the pros and cons are a bit more nuanced because if they stay under certain levels, they get support from most state governments to subsidise their stamp duty, but it's still a cost. Now, the big negative is that it's likely politically to need to be what we call an opt-in system. So you will look at when you're buying a property and decide, so long as it hasn't had land tax before, decide if you're going to pay the lump sum or the ongoing lands tax. And one would suggest if you're thinking you're going to hold that property for 20 years or more, you might decide on the upfront. But for the government, what a drag on revenue. And I think it's going to be difficult for them to proceed with this without other adjustments from the Commonwealth for support for the states, because it's not going to be neutral or positive for many, many years. But let's not underestimate how important it is to do it.
Meanwhile, there's been an increase in loan interest rates as well in the housing market. What are the implications of that?
Well, in a normal cycle, you'd normally expect variable interest rates to be lower than fixed interest rates, and that hasn't been the case. But in the last week, we've had big banks starting to increase their fixed interest rates. And one of the common questions I get is it time? Should I be fixing my rates? There's a couple of things to consider there. When you fix your rate, you give up something, and often that's flexibility. Say one of those offset accounts, you might not be able to make extra repayments. You also then restrict being able to move institutions because they have what's called break costs if you come out of fixed loans too quickly. What I would recommend people do, if you can't financially cope with an increase in interest rates, you should seriously look at fixing your rates. If you want flexibility, there are variable rates that you can lock in the percentage discount against the headline rate with institutions. And so that's a good risk management strategy for people who might be getting quite nervous with the likelihood of interest rates increasing. I mean, look at the RBA. They didn't increase rates on the Melbourne Cup day. That would have been a headline point for you. But what they are doing is they're not what we call buying back the bonds. And so they're expecting the 3-year rates, the cost of money to the financial institutions to go up. And that's why the fixed rates are going up.
Suzanne, always great to have you on. Thanks very much for joining us this morning.
Thanks, Johanna.